Okay, recording this video. It's Tuesday, 16th of September 2014. It's 3:05 a.m. Chicago time, and I thought I'd put out a little video on the bond market because we got FOMC starting today, Tuesday, with the kind of announcements coming out on Wednesday afternoon. And that means the equity market's going to be a little bit funky over the next couple of days, kind of go nowhere. We're just waiting for signals. And for me, I think this is going to be a really important FOMC kind of announcement. I mean, everybody thinks that they are all important, and the nature of the markets over the last several years has been that they are all incredibly important because everybody's taking their cues from them. But this one, technically, when you look at the patterns on the charts, I think is a really important one. So this is what I'm looking at on my charts. This is the 10-year futures contract. On TradeStation it's at TY. The little D just means I'm getting delayed data on the bond market because I don't trade it, don't have real-time data. And this is a weekly chart looking back over the last several years. So this is what I'm seeing. So we had a huge rush into bonds and the rates kind of come down since the crisis. But we kind of topped out in 2012 with this nice pullback to end of trend with an exhaustion pattern, first bearish divergence, and then we pushed up into a little bit of a test up at the highs here with a flush pattern. So that's a really nice kind of rounding out, topping out type pattern because it's got everything. It's got, in terms of price, it's got our end of trend. In terms of momentum, it's got our exhaustion patterns and then bearish divergence and flush. And then in terms of professional activity, we had blue professional up bars here and then testing them with Rambo, with amateurs getting wrong-footed, and then we had this kind of rush for the doors after this flush pattern where they sold it down really hard. But subsequently, what's happened in the last year and a half is we've had what I call a complex correction on the way back. I mean, everybody knows what a complex correction, but I'm saying this is a complex correction because when you look at it in terms of beta sine wave, you can see that we're testing back up, but the support and resistance levels don't really get broken. They kind of form this little bit of a narrowing channel on our way back up, and support resistance kind of holds like this. We get more flush patterns kind of going on. So for me, this is the end of a strong trend, and then a testing back up with just support resistance being played, complex correction on the way back up, narrowing channel, and then what normally happens after that, because we've had the exhaustion pattern and we're rolling over, we turn into a downtrend. So on the 10-year, we could see bonds kind of coming off and therefore rates going up. Technically, at this point, it's really interesting. And this particular meeting of the FOMC could be the kind of break that we get to the downside. Now that's the weekly chart. When you look at it on the daily chart kind of going on here, we've also had the first kind of sign of weakness with a break below support on the daily chart. So that's potentially taking us into a little downtrend. We've got resistance in here, we've got several weeks to play out before support kind of comes in here, and we've had the first sign of weakness with a drop below support. Now it's come into a Rambo pattern and a little bounce after Monday's trade, so the amateurs getting a little bit excited on the downside, and what you'd normally see is a breakdown here kind of coming back into the zone and then playing down, and a break below the low of that Rambo pattern. That would almost be a kind of a confirmed downtrend in place. So we got 2 days, day and a half of kind of data to come out on the bond market. Let's see if the bond market rallies a little bit. But as soon as FOMC comes out, that's going to be absolutely critical. And then the subsequent 2 or 3 days after FOMC, if we get a little bit of an exhaustion kind of up bar here, maybe a blue professional bar, the day of FOMC and the afternoon of FOMC, blue professional bar, and then it gets broken to the downside after a couple of days, that would be a really, for me, an important signal in terms of the bond market heading down and rates kind of going up. So that's the 10-year chart. Normally I look at the 30-year kind of as more, I don't know, I mean the 10 and the 30, they're both important charts, but I tend to look more at the 30 than the 10. But the 30, the pattern is not quite as pretty. The 5 it definitely is. So you can see on the weekly chart of the 30-year bond contract at US, we had the same pattern in 2012. Pullback to end of trend with exhaustion pattern, bearish divergence, flush up here, and then the move back up hasn't been a nice little kind of complex correction. It's just kind of overshot the resistance level there. and on the daily chart we've had a pullback to end of trend with exhaustion pattern and so on. This little down move here, we've got a support to put in, kind of amateur bar there, a little bit of strength out of the 30 years. So it's looking a little bit different, but the same thing. If we get a push back up, blue professional bar that then gets broken to the downside below this little kind of sequence here, then that's not good for the bond market. The 5-year is more like the 10-year. Same thing, pullback to end of trend. We had another little one pullback to dirty end of trend, exhaustion, bearish divergence, and we set off to the downside, and then we tested back in with this complex correction on the way up. And so we've got some time to run, resistance to support on this. It's kind of, you know, bearish divergence patterns happening here. On the daily chart, you know, we've got our first break below support here after an exhaustion pattern. And so, you know, a little move like that, a little kind of professional up bars that then get broken to the downside, bang, that's the kind of thing that would take us into a downtrend of the bond market. Another little kind of setup that I use, again, this is going to look pretty shitty on a small screen, but on a big screen it looks pretty good. I like looking at the interest rates. So these are, rather than the bond prices, these are the interest rates for each of those, and I put them up on a daily, weekly, monthly chart. Daily, weekly, monthly. So this is the 5, the 10, and the 30-year kind of going on here. The thing that I'm looking at the moment is the monthly. We're sitting under resistance on rates here. You know, we kind of bottomed out, pulled back to dirty end of trend, we tested back in, couldn't go anywhere, went the other way, and we're sitting under this resistance, kind of almost like itching to break into an uptrend. So that's rates on the 5-year going above 2%, bang, into an uptrend. And so, you know, because we're doing this at this time, just itching, waiting and waiting, that's the kind of, you know, the complex correction that I showed you on the last chart is like this little gathering, this little pattern of congestion, just waiting for a trend break on a monthly chart, and that will be important. So you can see it on the 5-year, on the 10-year it's a little bit further away at 3%, but you know, we're not heading down in terms of rates. We're trying to itch up and break into an uptrend here, and then this is the 30-year where we've already broken into an uptrend at this point, and so we've tested back down and we could be breaking back up again. So we don't have volume data or anything like that on rates. I'm just looking at the patterns, the way they've been kind of playing out in these charts. So for me, I'll just show you quickly, you know, commitment of traders. So bearish on the 30-year. Here we've got all these bearish divergence patterns on commitment of traders happening there. On the 10-year, this is the weakest of the lots. It's like, you know, the commitment of traders have kind of rolled around and starting to go negative here. So they're looking, and they've come back up to almost the zero line on the 5-year, but could easily kind of be rolling the other way. You know, that was as much strength we had in that kind of complex correction. So FOMC meetings are all important. This one particularly important in terms of what I see on my charts, and let's see how this complex correction kind of plays out over the next several months. But this week's activity, the next 5-7 days of trading in the bond market is going to be pretty key. So that's what I'm looking at. I hope your trading goes well over the next few days.